Okay, students, let me just show you what we have discussed in the first class, and then we'll go ahead, inshallah. In the first class, we did discuss basics of, I would say, AFM. Theoretical area we did discuss. I think entire first class was more or less it was a theory class rather than I would say numerics. But don't worry at all. From today's onwards, you will see the numerics as well. Just need. Okay, let's see. Hmm. All is okay, all is okay, alhamdulillah. We have started the topic cost of capital. Objective of cost of capital, we know that is simply investment appraisal. Obviously, if you don't want, if there's no investment appraisal situation, there's no need to calculate cost of capital. Objective is very clear. The second is meaning interpretation of cost of capital is simply cost of financing. We can raise the finance in the form of equity. The K cost is K, debt KD1 minus T, preference shares is KP. Okay, now let's start from K. K is cost of equity. Another interpretation is return required by the equity holders. Same thing will be cost for one party, and that's going to be a return for another party. For the company, of course, it is a cost of equity. For the shareholders, it is the minimum return required by the shareholders. Okay. K by using CAPM, capital asset pricing model. K is equal to RF plus RM minus RF and equity beta. K is cost of equity. Okay. Another interpretation is minimum return required by the shareholders. RF, risk free rate of return. Okay. It's a second live revision class. Don't forget this. So RF is risk free rate of return. RM. What is RM? Can I say average return on the stock exchange? RM is average return on the stock exchange. Again, RF, risk-free rate of return. RM minus RF. That is the difference of RM minus RF. It has a technical name. That is equity risk premium. Why do we say equity risk premium? If you are buying the shares of any organization, you will become an equity holder. Then obviously you are going to face risk. Premium means over and above something. Without taking any risk, you can earn RF. If you're going to the stock exchange, you will be facing the risk. That is what? Premium. It has another name also. Market risk premium. Okay, now what do you mean by this? That is equity beta. Before developing the understanding on equity beta, everyone should know. When we say beta, actually beta is a measure of risk. Beta is a measure of risk. When we say risk, there are two types of risk: systematic and unsystematic. Unsystematic risk is a diversifiable risk. Unsystematic risk is a diversifiable risk which you can diversify, reduce, even you can eliminate. A very simple interpretation is do not invest your entire investment, your entire fundings in one organization's shares. You should invest in different companies. So unsystematic risk can be diversified, it can be spread, it can be reduced, even it can be eliminated. Now, very important concept. There are a number of assumptions, but out of them, one assumption in CAPM is CAPM assumes that investor is having a well-diversified portfolio of investment. Since investor is having a well-diversified portfolio of investment, that is why we always assume unsystematic risk in CAPM is 0. So we are left with systematic risk. That is not a diversifiable risk. You cannot diversify this systematic risk. You have to face it. Examples. For example, you are operating in USA. Okay, your company is in USA. You're operating in USA. Assuming if the government increases the interest rate, you cannot bring it down. That's a systematic risk. If the inflation rate increases in that country where you are operating, systematic risk. Another example, if in your country there is political instability, if in your country there's political instability, so that is systematic risk. It's not a diversifiable risk. You cannot diversify this. Okay, now it means beta equity. It is also a measure of risk, but definitely beta equity will measure the systematic risk. Why beta equity is a measure of systematic risk? Because in capital asset pricing model, we assume that investor is having a well-diversified portfolio of investment. That is why unsystematic is 0. Now, unsystematic risk is 0, so we are left with only one risk, which is systematic risk. So we know beta means measure of risk. So equity beta is a measure of risk. But which risk beta equity is going to measure? Obviously, systematic risk. Now, please try to understand what do you mean by beta equity. Beta equity is a measure of systematic risk, which indicates that how your investment will respond to the changes in stock index. When a stock index is going to change, how your investment will respond to that. For example, assuming stock index has increased by 3%, and let's say your investment has increased by 6%. Now listen carefully. If you are earning more than the stock index, if your investment is having a rise more than the stock index, simply I can say that you logically you are getting a return more than the market. If your investment is performing so well, when the index increases by 3%, your investment has increased by 6%. It means your investment is a riskier investment, very risky. Why very risky? Basically, when you generate return more than the market, it means when something goes wrong in the market, you will have to face the loss more than the market. So that's a very simple example. If your investment is getting you a return even more than the market, so it's your investment is a riskier investment because, for example, let's say in any day, if your index decreases by, let's say 4%, then your investment, you never know, is going to reduce by 8%. Okay, now, very important, a very small data I'm just writing. We will have the two objectives as always, which I have explained in my regular classes as well. That small data will have two objectives. One, a very simple calculation, and the second is interpretation. So I want everyone to solve this, okay? Let's say risk-free rate is 8%. Assuming we have RM 12%. Number one, beta equity is 0. Beta equity is 0.75. Third, equity beta is 1. Fourth, equity beta is, let's say, 1.85. Students, please quickly, I want every one of you to calculate 4 obviously different KEs, and then we'll be discussing the interpretation as well. Plus, today's class is going to be very important. We are going to discuss the rearranged formula of MM plus tax equation as well on this OneNote as well as on Excel. And when I'll be explaining that formula on Excel to you, then I'll give you a time. So I want everyone to perform that steps with me so that you should know how to deal with that on the Excel. Another reason why this class is very important, towards the end of the class, I will explain the 3 areas where you need to focus to make a very good, I would say, command on your theory. So you will get to know what should be done for the theory, inshallah. Okay, answers are coming, but I want everyone to give answer. One student has answer, but I want others to reply as well. Please, you have 2 minutes to do it. And at the end of the class, there will be one public service message as well. And if you follow that public service message, I would say properly. So that application of that message in your life will only give you the benefit to you and your family. Plus, it will give the benefit to those people. They have lots of expectations from you. So purely the benefit will relate to you and people they are associated with you. I will personally not have any benefit. So the message is just for you, free of cost. So, okay, 4, 8, 11, 12. That's really surprised to, okay. Great, majority is having the same results, just last minute, and then we are solving it together. And please, if I forget the public service message towards the end of the class, so do give me a reminder. So I want that message. Everyone should listen it. Okay, number 1. Beta equity is 0. Students, equity beta 0 means your investment is risk-free investment. Always remember one point. When your investment is risk-free investment, then your KE will be equal to RF. Logically, risk-free investment means you have made investment in government bonds. In financial management, the benchmark of risk-free investment is government bonds. I need answer from anyone. Why in financial management benchmark of risk-free investment is government bonds? Please reply because I have answered this. What is the reason? Why do we say in financial management the benchmark of risk-free investment is investment in government bonds? Students, what is the reason behind that? Even though we have seen there are a number of governments, they collapse, they went bankrupt, defaulted, but still we say in financial management, benchmark of risk-free investment is government bond. Let's see what are the reasons, what the students are saying. Yeah. Okay. Correct answers, all are the correct answer. The reason behind this benchmark is, please concentrate on my wordings. Normally, governments, they do not collapse. I'm not saying they will never collapse. I'm saying normally they do not collapse. That is why we say investment in government bond is risk-free. So in number 1, equity beta 0 means logically you have made investment in risk. Your investment is risk-free. So obviously KE will be equal to RF and it is happening. 8% plus 12 minus 8 into 0 will make this all 0. So K is equal to. Now second, whenever your equity beta is less than 1, whenever your equity beta is going to be is less than 1, it means your investment is less riskier than the market. When my investment is less riskier than the market, so I'll demand the return less than the market. That is our second finding. Beta equity less than 1 means your investment is less riskier than the market. When my investment is less riskier than the market, then I'm going to demand the return lower than the market. And that can be seen here. K is equal to 8 plus 12 minus 8. And what is the beta equity? That is 0.75. That is 8 plus 3, 11. Am I right? Even though average return on the stock exchange is 12%, but we are still asking 11. There's a reason, because equity beta is less than 1. Third finding, whenever equity beta is equal to 1, we say this is a benchmark beta. Benchmark beta. Now, what do you mean by benchmark beta? Actually, benchmark beta means systematic risk of your investment is actually equal to the systematic risk of the stock index. So when your investment is having the same systematic risk which market is having, why I'm again and again putting so much emphasis on systematic risk? Reason we have already discussed, because in capital asset pricing model, we have an assumption. There are a number of assumptions. Out of that, one is investor is having a well diversified portfolio of investment. That is why unsystematic risk is 0. So we are left with only systematic risk. So beta equity is equal to 1 means benchmark beta. In that case, KE will be equal to RL. Obviously, when my investment is facing the same risk which is in the market, so I'll be demanding the same return which is on average in the market. So K is equal to 8%, 12 minus 8 into 1. So obviously, you can say that K is equal to 8 plus 4, 12%. Fourth and the last, whenever beta equity is more than 1, it means your investment is more riskier than the market. When my investment is more riskier than the market, then I'm going to demand the return more than the market. So KE will be more than RM. So let's see. K is equal to 8 plus 12 minus 8 into. The fourth one is 1.85. What is the answer? The last one is 15.4%. Okay. K is the 15.4%. Okay. Now, please, I want to tell you very important concept here. Logically, what is going to be a K from CAPM? What is going to be a K from CAPM? Actually, it depends on equity beta. When your equity beta was 0, so KE was equal to RF. When your equity beta is less than 1, we said your investment is less riskier than the market. So you will be demanding a return less than the market. When your equity beta is equal to 1, it's a benchmark beta. And in benchmark beta, actually what happens? You will demand the same return which is in the market. Now, I want to say something. Please listen. If somebody asks you a question, that is, what is the interpretation of KE from CAPM? What is the question? The question is, what is the interpretation? We know KE means cost of equity. By using CAPM, we have calculated, fine. But we know that this KE actually depends on beta equity. So we can say that KE from CAPM actually relates to the systematic risk of your investment, of course. It relates to the systematic risk of your investment. So logically, the KE which we are getting from CAPM, it depends on the systematic risk of your investment. It is higher, KE will be higher. It is lower, KE will be lower. If your systematic risk is 0, KE will be equal to RF. So never forget this interpretation. Now, another way to calculate KE from dividend valuation model. Simply, K is equal to D naught 1 plus G upon P naught plus G. Never make one mistake, never. You're not supposed to make, I would say, there are few mistakes which I have made a, I think, proper video. You can see that at the end of the course. There are 10 mistakes in AFM. You're not supposed to make any one of them because they are deadly sin. So if you make even a one mistake out of those 10 mistakes, that seriously, I can bet you that irritates the marker. So never make out of those 10 even a single mistake. Now, for example, if someone is using dividend valuation model, always make sure one thing. When you're using this model, your KE will be greater than growth rate. Because you are using this formula to calculate KE and you are bringing KE less than the growth rate, annual dividend growth rate. What is this? Look at this plus G. So logically, when we are using dividend valuation model, KE has to be higher than annual dividend growth rate. KE, we know that cost of equity. Another interpretation is minimum return required by the equity holder. D naught, current dividend per share. G, annual dividend growth rate, which we assume it is constant. P naught. P naught is current share price ex diff, means excluding dividend. We will never use cum diff price in this formula. We always use ex diff, excluding dividend. There are two ways to give you the cum diff. Number one, nothing is mentioned. We will assume given share price is excluding dividend. Nothing is mentioned. We will always assume given share price is excluding dividend. For the cum dividend, examiner is going to write cum dividend. Like, let me give you the two ways in which examiner writes this cum diff. For example, let's say examiner says current share price is $20 and in the bracket it says cum diff. So we know that it is cumulative of dividend. It includes the dividend. Now look at this. Current share price is $20 cum diff. Examiner says current share price is $25 and company is about to pay the dividend. This also means that this 25 is a cum diff value. Because whenever organization is about to pay the dividend and it is mentioned in the question, then always remember the price is going to be cum diff by, because as we know that stock exchange actually works on anticipation, perception, news, rumors. Obviously, as soon as the stock exchange gets to know company is about to pay the dividend, so that impact will be included in the share price, and obviously due to that your share price will increase a little bit due to that dividend impact. So one way of writing cum diff is categorically it will be written cum diff. Another way of writing the cum diff is Examiner gives you the current share price and says that company is about to pay the dividend. It means again the given price is cum div. Otherwise, nothing is mentioned. We always assume given share price is ex div. Okay. D naught is current dividend per share. G is the annual dividend growth rate, and we assume that annual dividend growth rate is constant. So D naught 1 plus G is actually equal to D1, which is next year expected dividend. D naught 1 plus G is equal to D1, and that is going to be next year expected dividend. For example, if it is D24, then 1 plus G will give you D25. Okay, one more thing. We know the formula. K is equal to D naught 1 plus G upon P naught plus G. By using this formula, if I make P naught as a subject, so P naught will be equal to D naught 1 plus G K minus G. So please, you should be really good in these things. If K is the subject, what is the formula? If P naught is the subject, then what is the formula? Okay, now. There's one more thing. That is Gordon growth model. By using Gordon growth model, we can calculate annual dividend growth rate. And obviously, data will guide you. Either you are supposed to use Gordon growth model or not. For example, annual dividend growth rate is not given. There is no any other information except the Gordon growth model to calculate annual dividend growth rate. Then you have to use it. So annual dividend growth rate is equal to B. Normally, we use RE, but in AFM, this formula little bit changes. In AFM, what happens? We say G is equal to B, K. This is what we use in AFM. In advanced finance, G is equal to B, RE. That is we use in FM. RE is return on equity. But in AFM, students, please never make mistake. In AFM, we replace RE with K. So G is equal to B, K. K, we know that what it is, cost of equity. B. B is the retention ratio. For example, if company is paying 40% dividend, then obviously we'll say that company is retaining 60%. If company is paying 40% dividend, it means company is retaining 60%. If company pays 30% dividend, then company retains 70%. And students never forget one concept. Companies, they retain to reinvest. It's not about company, even an individual. I would say majority of the individual, they do retain to reinvest. So companies, they retain to reinvest. Now, we said if company is paying 40% dividend, it means they are saving 60%. So look at this. B is equal to 1 minus payout ratio. Payout. How do we calculate payout ratio? Organizations, obviously, they will be paying return to the shareholders in the form of dividend out of their earning per share. So simply dividend per share divided by earning per share, or If you have not been given a data like on per share basis, no issue at all. Take the total dividend which company is giving. Total dividend divided by profit after tax, simply PAT. So if information is given on per share basis, then we will take dividend per share upon earning per share. In AFM, even FM also, we simply calculate EPS, profit after tax, divided by total ordinary shares. Obviously, here we do not apply IS 33. So in financial management, calculation of EPS is very simple. Okay. Let's see a question. Let's say we have D naught, $2. Earning per share is $8. Okay. That's fine. RF is 8%. RM minus RF. Let me write another name. Equity risk premium is 5%. Beta equity 1.25. I want everyone to calculate P naught. Please, everyone, attempt this. You have 3 minutes to do it. Please, I want everyone to attempt this. So far, I have got one answer. I want other students also to attempt this, please. One student is asking me, sir, when we will be having test? Whoever is ready for the test, just, excuse me, in your relevant WhatsApp group, ask admin to share test on cost of capital. They will share test on cost of capital. Attempt the test, and after that, you can watch the video. Let's say you have done investment appraisal as well. In your relevant WhatsApp group, ask admin to share the test on investment appraisal. You will get the test. On every topic, tests are available. As soon as you get ready for that, just ask the admin, they will share the test with you. After that, they will share the proper video lecture with you. And obviously, if you have any issue, you can always ask questions. Okay, let's attempt this. Now look at the data. By looking at the data, it is quite obvious. We have to go towards annual. We have to go towards Gordon growth model to calculate annual dividend growth rate. First, let's calculate K. RF is obviously 8%. Equity risk premium is 5. Equity risk premium, another name is market risk premium, the difference between RM minus RF. So KE we are getting 14.25%. B is equal to 1 minus payout ratio. Dividend per share is 2. EPS is 8. So a retention ratio is 0.75. G is equal to actually BKE. So retention is 0.75. KE we have calculated 14.25%. We are getting annual dividend growth rate. Annual dividend growth rate is 10.6875%. annual dividend growth rate is 10.6875%. Okay. Or you can just take 10.68, no issue at all. It's 10.69. It's all acceptable. P naught is equal to D naught 1 plus G. With a little bit rounding off, you can take this. Just to make it easier. Okay. P naught is equal to D naught is 2 into 1.1069 divided by what is K? K is 0.1425 minus 0.10. So 0.1425 minus 0.1069. 2 multiplied by 1.1069 divided by 62.18 or 62, 63, all are acceptable. One more variety. If examiner gives you the information like, let's say dividend per share is $0.40 in 2020. Dividend per share is $0.44 in 2021. 46 in 2022. 2023. This is the information plus current share price is 12.54 cum div. Last year is the always the current year. If nothing is mentioned, obviously required. Okay. Students, whenever you have been given information like this, so basically we calculate average annual dividend growth rate, but how do we calculate? That's very important. You have to consider all the values. How? Small g is equal to last dividend per share divided by first dividend per share. Power is going to be 1 upon n minus 1 n minus 1. Let's apply. The last dividend is 0.54 and the first dividend is 0.40. We have been given in dividend of 5 years if you count. So power is going to be 1 upon 4. Obviously, in the first year dividend, there was a first time in the dividend information we got, that is 0.40. After that, there will be a growth. So if examiner gives you the information of 10 years, the power is going to be 1 upon 9 minus 1. Okay, now, how do we solve? That is very important, please, students, so that you should not be having problem. Actually, 1 upon 4, power 1 upon 4 means mathematically 1 upon 4 means 0.25. Mathematically, 1 upon 4 means 0.25. Now, please listen these steps properly. First, 0.54 will be divided by 0.40. So 0.54 divided by 0.40. I'm getting 1.35. The answer of within the bracket, I'm getting 1.35. Now you have to take power 0.25. I'm getting 1.0779 minus 1. Multiply by 100. I'm getting 7.79. So you can make it 7.8 or even 8. All are acceptable. 7.8%, or for the sake of simplicity, you can take it 8%. No issue at all. The rounding off will not disturb you. Now, current dividend is 0.54. If someone is working on 8%, someone is working on 7.8, all are acceptable. Please do not get confused in that. Current share price. Can I say, students, the current share price will be 12? Because in DVM formula, we use X diff price. So we have to deduct the dividend. Plus that 8%. So 0.54 into 1.08 divided by 12 plus. I'm getting 12.86%. I'm getting 12.86%. Okay, now let's discuss other areas quickly. Then we'll come back to KE again. In fact, let's stay with CAPM right now. Look at this. Approach of calculating current WACC. Let's say there's no diversification, nothing. We are just calculating existing WACC of the company. We're calculating current WACC of the company. What do we do? Simply, let's say, if examiner has, there's no diversification, just data is given and we are calculating current WACC of the company. We're just calculating existing WACC of the company. Fine. So simply, if information is giving relating to the CAPM by using, for example, we'll be calculating KE either by using CAPM or DVM, depends on the information. Let me, students, repeat, depends on the information. If examiner has given me the information of CAPM, so I'll be using the CAPM. If examiner has given me the information of DVM, I'll use DVM for calculating KE. Fine. One question and let me answer. What if, it never happened so far, but what if examiner has given you a really big amount of data and you can calculate CAPM by, you can calculate KE by using CAPM as well as DVM. Students, if this is the case, we always prefer KE from CAPM because CAPM is a superior model for calculating KE as compared to DVM. Because dividend valuation model is having more limitations than CAPM. So if examiner gives you a really big amount of data, and by using CAPM, you can calculate KE, or let's say in the same question, let's say DVM is applicable also and KE is coming. So we will always prefer KE from CAPM. One more question and answer. The question is, am I going to get the same result from both the formulae? The answer is no. You will not get the same result from both the models. Okay. Is there any situation in which we can get the same result from CAPM and DVM? The answer is yes. There is only one situation in which both model will give you the same result. And that is in case of perfect capital market. In case of perfect capital market. Now the question is, what do you mean by perfect capital. Actually, perfect capital market means where BOD and shareholders are having the same information. Students always remember one point: this market does not exist. It will never happen that BOD and shareholders, they will be having the same information. Until unless whoever is sitting in the BOD, they are the only shareholders of the company, then the scenario is different. Otherwise, practically it is not possible. Practically, shareholders, they will have a different information than BOD. So only there is one situation in which CAPM and DVM both will give you the same KE, that is in case of perfect capital market. And what do you mean by perfect capital market? Perfect capital market means where BOD and shareholders are having the same information. Since this market does not exist, that is why both will not give you the same result. Both will not give you the same result. Okay. And which one is better? CAPM is better than DVM. Now, so either by using, it depends on the information, by using CAPM or DVM, you will calculate K. Let's say you have calculated the K. We'll come to KD1 minus T also. Let's say you have calculated KD1 minus T also. Then by using WACC formula, simply we'll calculate the WACC. By using the WACC formula, we will simply calculate WACC. So just calculate KE, then KD1 minus T, and then use formula WACC. The main thing is now approach of calculating risk adjusted WACC in case of diversification. That is very important. Approach of calculating risk adjusted WACC in case of diversification. Let's say we are diversifying. Diversification means making investment in a non-core activity, doing something different. Diversification means doing something different, making investment in a different industry. That is diversification. In case of diversification, actually what happens? Your existing equity beta becomes irrelevant. Why? Because in case of diversification, your business risk will change. So what is the approach of calculating risk adjusted WACC? Step 1. To find beta acid of new industry. To find beta acid of new industry. How do we find beta acid of new industry? There are two possibilities. Number one, if examiner is nice towards you, I would say very nice, then examiner might give you directly the beta acid of new industry. Chances are almost zero. Examiner is not so nice towards the students. So what to do? Then basically we have to calculate beta acid by using the information of proxy company. Proxy company means simply your competitor in the new industry. So you will be using the information of proxy company to get beta acid. Beta acid means ungeared beta, the beta which does not have the financial risk. Beta asset means which only incorporates business risk. So how do we find this beta asset? Simply, you have to de-gear equity beta of proxy company. To de-gear equity beta of proxy company. De-gear means ungear. So you will be converting beta equity into beta asset. So we'll be using beta equity of the proxy company. We'll be using financial gearing of the proxy company. Or we will be we will be actually converting beta equity to the beta asset. In these steps, student, never forget one thing. Beta equity will always be higher than beta asset. Why? Because beta equity is a two risk beta. It measures financial risk and business risk. Actually, financial risk relates to your financial gearing, debt, loan. When there is a loan in the business, you have to face the financial risk. Business risk means simply fluctuation in your operating profit. Obviously, your earnings, we can say no company is having same earnings every year. Operating profit keeps changing. So basically, fluctuations in the operating profit, that is your business risk. So always remember one point, beta equity will always be higher than beta asset because beta equity is a measure of two risk beta, financial and business. Beta asset only is a one risk beta and it only measures business risk. So in step one, we'll be taking the proxy company financial gearing, proxy company equity beta, and we will calculate beta asset. And we know that when we'll be converting, when we'll be de-gearing beta equity to get beta asset, answer should be less than beta equity because beta equity is always higher than beta asset. Okay, now listen. I need to calculate beta asset. It is equal to beta equity into market value equity divided by market value equity plus market value debt 1 minus tax rate plus beta debt. VD1 minus T. VD1 minus T plus V. Beta debt shows the risk of default, and I would say normally in AFM we assume that beta debt is 0. Due to that, you will always see this formula. Beta asset is equal to beta equity. V is market value equity. V is market value equity. Market value equity. Market value debt 1 minus tax rate. Now please listen carefully. I said normally in AFM beta debt will be 0. But there's no guarantee it will be 0. What if beta debt is given? Then what should be done? If I have to use the entire equation, then how I'm going to use that equation on Excel? I have already explained that. I hope you people have seen that video. If not, then in the next class, I'm going to explain this also. Don't worry at all. Because in today's class, my main focus is let's discuss the rearranged formula of MM plus tax equation. Let's say you have taken proxy company equity beta, market value equity, market value equity, market value debt 1 minus tax rate, and you have found beta asset. Step 2. To gear up. Gear up means including the financial gearing. Now you want to include the gearing. To gear up this beta asset with your own company's financial gearing. Let's say I'm solving the question for APLC. So I'll be taking the gearing of APLC. Now we will be converting beta asset to beta equity. So beta equity will be the subject, is equal to beta asset. Now the formula will be V plus VD, 1 minus tax and V. I have written the formula of beta equity in such a way that you can use in Excel. Otherwise, obviously in Excel, it becomes difficult. So you should know that when you are converting beta asset to beta equity, what is the formula? And when you are converting beta equity to beta asset, what is the formula? Step 1, let me repeat, in case of diversification, step 1 is to take equity beta of the proxy company, take the gearing of the proxy company and calculate beta asset. That is ungeared beta. You have calculated ungeared beta, then you need to gear up this beta, ungeared beta with your own financial gearing to calculate beta equity. Let's say you have calculated beta equity, then job is done. By using kappa, then we can calculate KE. Please look at the steps. Step 1, to find beta asset of the new industry. How do we get this beta asset of the new industry? We de-gear equity beta of proxy company to calculate beta asset. Once you have calculated the beta asset, then we use our own financial gearing to calculate beta equity. After calculation of beta equity, we used CAPM to calculate K. Now, student, please listen and listen carefully. Please listen. Let's say you are solving a cost of capital question on diversification, and you badly need proxy company equity beta. You badly need. Because we know the steps. What are the steps? Step 1, to find beta asset of the new industry. How do we find out? We take proxy company equity beta, we take financial gearing of the proxy company to calculate beta asset. Once you have calculated the beta asset, then what do? We gear up that beta asset with our own financial gearing. Let me repeat. You badly need equity beta, and it is not given to you. Plus, you cannot calculate it. There's no information by using that you can calculate K, you can calculate equity beta. It is not available at all. So when we need equity beta, and we don't have information to calculate that also, and we need badly, and we know that we cannot solve without that equity beta. Number 1, it is not given to us. Number 2, there's no any information by using that you can calculate equity beta. In that case, please student, listen. When you need beta and it is not given to you, make it more easier. When beta approach is not possible, even though we need, but it is not possible, then we go for plus tax equation. Then plus Miller and Modigliani tax equation. That is proposition 2. Always remember one point, plus tax equation is the alternative of CAPM. Repeat. Plus tax equation is the alternative of CAPM. And when do we use this plus tax equation? When we need beta and it is not given to us. Okay, now please. Plus tax equation, you will get this in the formula sheet also. K is equal to K I number. Actually, when financial risk changes, then we talk about APB. That is why I'm not discussing it. Logically, then we talk about APB. K is equal to, because the best way is when your financial risk is changing, then the best way is go towards APB. Okay. Let's say if examiner has just changed the financial risk and no change in the business risk, then and plus it is not a question of APB, and examiner is asking you to calculate WACC, so still we can calculate. Then what are we going to do? Please listen it carefully. You will take existing equity beta of your company, existing financial gearing of your company. You will de-gear beta equity of your company. You will get beta asset, and that beta asset will be gear up with the new gearing. Is this clear now? What will be done if there is only change in the financial risk? Okay, now please focus on this plus tax equation. That is main point of today's lecture, I would say. KE is equal to KEI number plus 1 minus tax rate multiply by KEI number minus KD BD upon V. Okay, now this is the formula which you will get in exam, no doubt about it. But I always say to my students, just little bit change. KE should be replaced with KEG. That makes more logical. KEG means cost of equity of geared business. KEI should be replaced with KU. Cost of equity of ungeared business. So simply KEG is equal to KU 1 minus tax rate into KU minus KD into VD upon V. Okay. Now, please, students, listen to me carefully. Means carefully, okay? This is 1 plus tax equation. Now in AFM, they have rearranged this equation. The question is why they have rearranged this equation so that you can solve that on Excel. Earlier, it was complicated to solve on Excel, even though in my class, I did discuss how to solve that on Excel as well. But now, obviously, we'll be using the rearrange formula. Rearrange of this formula or rearrange plus tax equation. That is proposition 2. That is KEG plus 1 minus tax rate. And never forget one thing, please, student. K is actually representing KG. KI is representing what? KU. KU means cost of equity of ungeared business. KG means cost of equity of geared business. Geared business means which has the financial risk. KU means the business which does not face any financial risk. It has only business risk. KU. KEG has both the risk, business plus financial. Okay, KEG plus 1 minus tax into KD VD upon V. That will be your left hand side is equal to right hand side, which examiner will give you and it will be given to you in exam. That is KU plus 1 minus tax rate KU VD upon V. This is what ACCA gives you. And please come here. KE is actually KEG, KEI is KU. I have made little bit more adjustment to that to make it more easier, which surprisingly ACCA people have not clearly taken in the formula. They have taken while solving, obviously they had to do it. Mathematically, we can take KU common. If I take KU common, so it will be like this. 1 plus 1 minus tax rate into VD upon V. Now you might be thinking, sir, what is the big deal in taking you have just taken the common? The question is, the answer is, I have taken the common KU. Other people have not taken. ACCA is giving you this. I am saying take KU common so that you should not have a problem. Now listen. Left hand side and right hand side. Now, how we are going to use this rearrange formula? Number one is when we are going to use it. Number one, when you need beta and it is not given to you, so you have to go towards mm plus tax equation. Now, please listen to me carefully. In step one, we will de-gear. To de-gear KG of proxy company. To calculate KU, the first step will be to calculate to de-gear KG of proxy company to get KU. How will you get KU? You will solve left hand side, right hand side as well, and after that, in the final step, KU will be equal to left hand side answer divided by right hand side answer. This will actually give you the KU. You can see that entire left hand side will be solved properly, but right hand side will have the KU as well. So logically, left hand side will be divided by the right hand side. That will give you KU. Let's say you have managed to calculate KU. Look at the step 2. Now, to gear up, KU with your own financial gearing. Now we'll be converting KU to KG. Cost of equity of ungeared, we'll be converting into cost of equity of geared. Now in step 2, you will be using the first equation, this one. Why? Listen, student, you have calculated KU. 1 minus T, everything is given to you. Now like it. So in step 1, we'll be using the rearrange formula. In step 2, we'll be using a simple formula, which says KG is equal to KU 1 minus tax rate KU minus KD. So actually you will be using both of them. Let me repeat. For calculating KEU, you will be using the rearrange formula, the left hand and right hand side. Once you have calculated the KU, then you will be using the first formula, first equation, a simple equation. That is KEG is equal to KU 1 minus T and KU this. Now let's apply this for a minute so that, assuming we are working for APLC, market value equity 400 million. Market value debt is 100 million. Okay. APLC is diversifying to the new industry. In the new industry, proxy company is BPLC. Let's say examiner says BPLC, market value equity is 420 million. Market value of debt, let's say 168 million. Other info, tax rate is 30%. KD is, let's say, 5%. Okay. Required. Risk adjusted back for APLC. Okay. KE KE of BPLC is, let's say, 14%. Okay, fine. KE of BPLC is 14%. Always remember one point. Whenever nothing is mentioned, the given KE is actually KEG. Whenever nothing is mentioned, so simply KE is your KEG. Okay. Now, what are the steps? Step 1 is to find KU. Or if someone is okay with KEI number, it's up to you. You can use KEI number. To find KU or KEI number, it's up to you. By de-gearing KE of BPLC. And we know that KE of BPLC is actually KEG. Okay. Now come here. We'll be using this formula. There's no need to write the formula while solving the question because this formula will be given to you in exam. Left hand side and right hand side. We'll take KEG 1 minus tax KD VD upon V. To find KU or KEI number by de-gearing the KU of BPLC. Okay. First, we'll take 14%. That is, let's say 0.14. 1 minus tax rate into KD is 6%, 5%. 5% means 0.05. Then market value of debt upon market value of equity, 168 upon is equal to KU 1 plus 1 minus tax rate into VD upon V. VD is 168. So let me use the calculator. Then obviously we'll be solving this on the Excel also. I want everyone to use the calculator so that there shouldn't be any mathematical errors. 168 divided by 420. Then I'm multiplying this with 0.05. 1 minus 0.3 will give me 0.7. Students, left hand side, I'm getting the answer of left hand side 0.154. Please check yes or no. 168 divided by 420 into 0.7 plus 1. Here I'm getting 1.28. Left hand side divided by right hand side. Whatever comes, multiply by 100. 12%. 12.03 perfect. But it's my request, students, please do solve this right now on your calculator. Then we'll be solving on Excel, inshallah. So this is first step. After that, obviously, very easily we can calculate. We can perform second step. To gear up KU 12% with APLC's financial gearing. Okay. So KEG is equal to KU, which is 12%, 1 minus tax rate, 12% minus KD, which is 0.05. into market value of debt. We'll take market value of debt of APLC. What is that? 100 upon 400. So what are we getting? Students, I'm getting KG 13.225%. Please check yes or no. Then I'll discuss a very important assumption here. Actually, 100 divided by 400. The answer of 0.12 minus 0.05. Answer of this bracket is actually 0.07. And answer of this bracket is actually 0.7. How will you solve? Let me repeat. First, please listen to me carefully. 100 divided by 400. Whatever comes, multiply by 0.07. Whatever comes, let's say, multiply by 0.7. Then whatever final answer comes, multiply by 0, add 0.12. You will get this. Obviously, whatever the final answer comes, multiply that answer with 100. You will definitely get 13.225. Let me repeat again what I did. 100 upon 400, then 0.07, then 0.7, whatever came, plus 0.12. Is this clear, the steps? Obviously, after that, we can very easily calculate back. There will be a risk adjusted back. 13.225. Market value of equity, that is 400 divided by 5. KD is 5, so 1 minus tax rate, I'll get 3.5. Hundred upon 500. Let's see what is the final answer of the back. 13.225 into 400, 3.1. 11.28. Yes or no, please? And obviously, this is logically a risk adjusted back. 11.28. 13.225 into 400 plus 3.5 into 100, whatever comes, divided by 500. So basically, the risk adjusted back is 11.28. I hope it is clear to everyone. Yes or no? Okay. Now the main thing is how to solve this on Excel. You have to see the steps, and I really want everyone to perform as well. But please first watch, then perform. Let me at least let me take the picture of the data so that no need to. Okay, let me tell you one assumption. Listen carefully, student. Please, that's an assumption in MM plus tax equation, and you people are very nice. You did not ask the question, but let me tell you this. Let me change the color for this assumption. Please look at this. Look at this. When we took proxy company information, we utilized KD 0.05. So when we were de-gearing, we used the KD 0.05. And here we are gearing up. Here we are gearing up. Look at this. Again, KD I'm using 0.05. Now please listen to me carefully. In MM plus tax equation, while de-gearing and gearing up, KD remains same. That is the assumption of MM. Please, I'm repeating it. while degearing and gearing up, KD remains same. That is the assumption. And it will be very nice of you, and it will leave a really good impression, I would say, if it comes in the exam and you're using the same KD and you do write this as well, that it is one of the assumptions of MM plus tax equation while ungearing and gearing up, KD remains same. Let me take the picture of the data so that we can go for Excel. Just a minute. Share. Okay, done. Now let me bring the Excel. Just a minute. Okay. Let me share this Excel sheet with you. Students, there's no need to write the formula data. Everyone knows that. So I just want to perform the steps. So step 1 is simply to degear kg of proxy company BPLC. And this is, can I say, left hand side? Let us now first solve left hand side. Okay. Students, in left hand side, first I have to take KEG. Yes or no? What is the percentage of KEG of proxy company? Can I say it is 14%? It is 14%, am I right? So I'm taking it 0.14 plus 1 minus tax rate. 1 minus tax rate. Okay. I'll show you all the variations. Tax rate is 30%. 1 minus tax rate. Can I say it will give me 0.7? Yes or no? Please reply. Multiply by KD. KD is 5%. Can I say 5% means 0.05? 0.05. Then multiply. Then multiply this with market value debt upon market value equity. Proxy company debt value is 168. Am I right? 168. Equity value is 420. Bracket close. Look at the answer, students. Left hand side answer is 0.154. I think the same answer came when we solve on OneNote. Let me show you this. Now, if a student says, I want to use exactly the same formula, student says, instead of writing 1 minus tax rate 0.7, I want to show 1 minus tax rate. Let's do it. Please keep watching that fx is equal to. If I put bracket here, 1 minus, let's remove this, take 3, close the bracket. Can I say now we have written 1 minus t? Is that clear? The same result. Students, can you see that? If any one of us does not like to use directly 0.7, that student actually wants to use exactly 1 minus tax rate. I hope it is clear to everyone. We are getting the same result left hand side. Students, you can at least reply on that. Okay, now, if you go towards right hand side, here, right hand side is equal to, what do we have in right hand side? Obviously, I am not writing KU, otherwise in the cell you cannot solve it. I'll take 1 plus 1 minus tax rate, bracket 1 minus tax rate, bracket close, multiply by VD upon V. VD is 168, V is 420, bracket close, 1.28. Now, KEU, you have to write now left hand side divided by right hand side. KU is equal to left hand side divided by right hand side. I'm getting this. Convert this into percentage. Students, KU is 12%. Is this clear to everyone? Please reply. How do we use this rearrange formula? Great. Now, what are we going to do? To gear up 12% with APLC financial gearing. So simply KEG is equal to, we'll take KU, okay. You can write 0.12, you can directly take 12%, there's no issue at all. Let's say if I take 12% plus 1 minus tax rate, 1 minus tax rate, multiply by bracket KU minus KD. Can I say KD is 5%? Bracket close, multiply by. We'll take market value of debt. A company is having market value debt 100 million. Am I right? Equity value is 400. We are getting 13.2617% if you bring it. So we're getting 13% or 13.3 or 13.26. It's exactly the same result which we got earlier. Now, instead of, let's see one more variation. Instead of 12%, if someone has used D5, 0.12, let's see what happens. 0.12. Keep watching. I'm writing 0.12. Then obviously instead of 5%, I'll use 0.05. 0.05. I hope it is clear to everyone now. Students, please reply. Is this clear? If someone is using 0.12, then what happens? 12%. You will get the same result. Great. I hope now everyone should be having a really good grip. How do we use this rearrange formula? When do we use this? That is very important, okay? For this coming attempt, obviously. Great. Now, how we'll be calculating a WACC if we need to use that beta debt also? I'll be explaining that inshallah in the next class. Don't worry at all. Now I'm going to take only 2 to 3 minutes to end today's session. And you might have observed this second live revision class is longer than the first one. Okay. So slowly and gradually, obviously frequency will also increase. Instead of 1 class per week, we'll go for 2 classes per week. And near to exam, there's a possibility of 3 classes of the revision per week. But obviously then if we go for 3 classes, time reduces. If we go for 2 classes, time will be little bit more than 1 hour. Okay, number 1. How to basically make your theory very, very strong. What we have done by Monday, otherwise maximum by Tuesday, it will be shared with every students. In our AFM book 2, at the end of the book 2, we are going to share 3 things. One is L plus R, that is learn plus repeat list. What exactly you need to, obviously I have explained each and everything in my regular classes. But L plus R is learn plus repeat theory, which should be on your fingertips. Number 1. Number 2, all the articles which I have discussed in my pre-recorded lectures, but obviously all the articles, they were not discussed in one sequence. Let's say we might have first discussed the article on BSOP, and after that we might have discussed the other article. Then we might have discussed the behavioral finance. So what we did, we have discussed all the relevant articles in AFM, but obviously in different videos. So I have admin, not me. Admin has compiled all those articles for you at one place. That will be added. Second area of the theory. Third, what we have done, most frequently asked question in AFM, which more or less almost in every attempt you will see questions, they are coming in AFM. We have combined them also. So if you go through 3 areas, one is L plus R, second is article we have combined, and the third is most frequently asked questions. So after that, I can guarantee you, assure you, you will not have any issue in the theory at all. Agenda for the next class is little bit more discussion on cost of capital, and then we'll go for investment appraisal. Okay. And just last minute, a public service message for all of my students, very important, and that only relates to you. Basically, there are a number of theories, assumptions in MM, but right now the very important assumption is one, which I have explained, that is, while gearing and degearing, KD will remain same. The rest of the assumption I'll share in the notes, don't worry. Okay, now, a public service message for all of you. Please listen it carefully. If any one of you is not doing daily exercise, so please start doing it before it is too late. Please. See, if you can take care of yourself properly, then you will be able to take care of those people that are depending on you, like your parents, your younger brothers and sisters. If you are a married person, your obviously wife, your children. So there are actually plenty of people that depend on you. Exercise means obviously workout. If you can hit the gym, then that is excellent. At least take out 1 hour for your workout. At least. It is very necessary for you, and especially people they are associated with you. They need you, seriously. Your parents, they need you. If you are a husband, obviously your wife, your children, they need you. For that, you need to work out. I'm telling you. I've seen people at a very young age having problems. See, taking out 1 hour for that, there is no need that first you will be doing ACCA and after that you will do that. You can even start from tomorrow. And I'm not asking take 1 hour from tomorrow. You can take out 15 minutes, 20 minutes, and then slowly and gradually increase the time. But it's my humble request. Do it regularly. Seriously, do it regularly. it is going to give, you will be the only one who will get the benefit, not your teacher. And obviously people they are depending on you, they will get the benefit, not me. So it was public service message from myself. So because nobody gave me this message when I was a student, so I realized why not, I should give this message to at least my students. So from here onwards, almost in every day, I'll giving you the public service message as well as a reminder. So students, thank you very much. Do give the feedback of today's class, and you might have observed today's class is far more better than the first one. So in every live revision class, inshallah, you will see more participation from the students and obviously more discussion from the tutor as well. And by Monday, otherwise maximum by Tuesday, you will get each and everything regarding theory as well. So students, thank you very much. Yeah, you can think for the theory while push-ups at the gym, do it. It will be great fun. Thank you. Thank you, students. Thanks a lot.